There was a moment I realized the guy managing my money had no idea what he was doing. Not a suspicion, not a feeling, a moment. He called me on a Tuesday afternoon, confident as ever, and told me he had a good feeling about a biotech stock. A feeling. I'm sitting there thinking, I'm paying this man a percentage of everything I own, and he's running on vibes. That was the day I started questioning everything I thought I knew about how money actually gets managed in this country. And what I found changed how I look at Wall Street, investing, and honestly, my own financial future.
Let's go back, because to understand where we are now, you need to understand how we got here. For most of modern financial history, investing was a relationship business. You found a guy, usually a guy, with a nice suit and an expensive watch, and you handed him your money and trusted him to grow it. These were the Gordon Gekko types, the Jordan Belforts, the men who walked into rooms like they already owned everything in it. And their method was simple. Read some filings, listen to some earnings calls, analyze the numbers, and then, more often than not, ignore all of it because they had a hunch. Sometimes they were right. More often, they weren't. But at least it felt human. There was always a story. The management looks strong. The balance sheet is clean. The stock feels cheap. Which, if we're being completely honest, is just astrology for men who wear cufflinks. And for decades, that was fine. Markets were inefficient. Information moved slowly. If you knew something before the next guy, you could make real money. The advantage was real. But then something shifted, and it didn't come from Wall Street. It came from math departments. Guys with PhDs from MIT and Harvard. Guys who had won math Olympiads as teenagers and spent their 20s dreaming in probability distributions. These weren't your typical finance bros. These were people who looked at the stock market and didn't see companies. They saw patterns. Statistical patterns, repeating behaviors, exploitable inefficiencies, hiding inside what most people wrote off as noise. And in the late 1980s, they started building something. Quantitative investing. Instead of asking, is this a good company? They were asking, given these variables, what's the statistically expected outcome? Rules over narratives, math over gut feelings. No CNBC, no Bloomberg hunches. Just pure signal. And the firm that took this further than anyone else was a company called Renaissance Technologies. Most people have never heard of it, which is wild, because their flagship product, the Medallion Fund, is widely considered the most successful investment vehicle in the history of financial markets. Founded by mathematician Jim Simons, the Medallion Fund ran on pure math. Algorithms, statistical models, machine learning before machine learning was a buzzword. No fundamental stock picking, no conference calls with executives, just data telling the system what to do. And the returns? Over 60% annualized before fees for more than 2 decades, around 39% after fees. To put that in context, Warren Buffett, one of the greatest investors who ever lived, averaged around 19% annually over his career. If you put $10,000 into Buffett's strategy and let it run for 20 years, you'd walk away with roughly $324,000. That same $10,000 in the Medallion Fund? About $7 million. Same time frame, same starting amount, completely different result. That's not just impressive, that's a different category of performance entirely. And it started changing how serious institutional money thought about investing. Instead of backing some guy with a story and a handshake, capital started flowing towards systems, algorithms that could react to price movements, order flow, and volatility at speeds no human being could match. But here's where the story splits. Because while institutions were quietly moving towards quant firms, something else was happening with everyday investors. The data was coming in, and it was brutal. Study after study was showing that roughly 90% of active fund managers, the suit-wearing, storytelling, gut-feeling professionals, were underperforming their benchmark over long periods. Not occasionally, not just in rough years, consistently. And on top of that, they were charging you for the privilege. So investors started asking the obvious question, why am I paying someone extra to make less money than an index? That's when index investing took off. Low cost, passive. No story, no manager, no ego. Just buy the whole market and let it run. Instead of searching for the needle in the haystack, People just started buying the haystack.
And it worked, and it spread, and it put a lot of financial advisors in a very uncomfortable position. Because here's the thing most people don't realize about what financial advisors were actually selling. It wasn't alpha. It wasn't market-beating performance. What they were really selling was access. Access to markets, access to products, access to information that most people couldn't get on their own. And then the internet showed up. Overnight, information asymmetry disappeared. Market data became free. Research tools went from expensive and exclusive to sitting right there in your browser, free to use.
The financial advisor stopped being the gatekeeper. And when that happened, the 1% annual fee they were charging started feeling a lot harder to justify. Think about travel agents. They didn't disappear because people stopped traveling. They disappeared because booking a flight stopped requiring a phone call. Stockbrokers didn't vanish because people stopped trading. They vanished because placing a trade online was faster and easier than calling someone on a trading floor. When access becomes free, the middleman gets replaced by technology. That's not a new story. That's just how industries evolve.
And that's exactly the space robo-advisors stepped into. Platforms like Wealthfront and Betterment started offering something that felt almost too good to be true. Automated portfolio management, rebalancing, tax optimization, all without the fees, without the meetings, and without Gary explaining beta with a laser pointer. And investors responded. 10 years ago, Wealthfront had around $2 billion in assets under management. Today, that number has grown to $80 billion. Globally, robo-advisors managed about $187 billion in 2017. By 2023, that number had climbed to nearly $2.8 trillion. And by 2027, it's projected to hit $4.7 trillion. That's not a trend. That's a structural shift.
But here's the part that surprised me, and the part most people get completely wrong about robo-advisors. They're not as personalized as they make you feel. When you sign up, you fill out a questionnaire. Your age, your income, your goals, your risk tolerance. It feels thoughtful. It feels like they're building something just for you. But what's actually happening is you're being sorted into a bucket, a model portfolio shared by thousands of other people who answered similarly. The algorithm isn't crafting a unique plan for your life. It's finding your category and placing you inside it. That's not necessarily bad, but it's important to understand what you're actually getting. Robo-advisors were built to replace the operational side of financial advising, the paperwork, the rebalancing, the tax loss harvesting, the boring, repeatable stuff that advisors used to charge real money to handle manually. They were never designed to replace the thinking part of investing, the part that actually requires judgment and context and nuance. Which means they're powerful tools when you understand them for what they are, and they're disappointments when you expect them to be something they were never meant to be. Here's what I actually believe after going through all of this. We are living through a moment in financial history where three different worlds are colliding at the same time. Quant firms are replacing discretionary fund managers at the institutional level. Index funds and ETFs are replacing active management for everyday investors. And robo-advisors are replacing the operational role that financial advisors used to fill. None of these things are happening because the old way was evil. They're happening because technology got good enough to do the repeatable parts better, faster, and cheaper. The story of Wall Street has always been about who controls information and access. For a long time, that was a small group of people in expensive suits. What we're watching right now is that control spreading out to algorithms, to platforms, to individual investors who never would have had access a generation ago. And the question isn't whether this is good or bad. The question is whether you're paying attention. Because the people who understand this shift, really understand it, aren't the ones panicking about AI or automation taking over finance. They're the ones quietly repositioning themselves to take advantage of exactly what's happening right now. The market doesn't care about the old rules. It never did. It only moves forward.